So often I get asked by mostly investors or sometimes advisors, like, why don't you do more with the Magnificent Seven? You know, you have the largest 7 companies in the world, some of which pay dividends and, most of which don't. Why don't you do something with them? And believe me, I am super tempted. But I want to do a show specifically on the risks of relying on the Magnificent Seven from a dividend perspective.
Right.
So I'm not setting this up saying a Magnificent Seven portfolio is bad. We do invest with a lot of these companies, all the ones that pay dividends. But I also say at the end of the day, thinking of the Magnificent Seven as a dividend portfolio because some of them pay can be very, very dangerous.
You got to really do your research and make sure that it's, if you're going to include them into a portfolio that you're managing, you got to make sure you've got a little bit of offset there to help you as well.
Yeah. There needs to be more than just the Magnificent
That's
Seven.
right.
So who are they? Apple,
Microsoft,
Alphabet, which is Google.
Yep. Amazon,
NVIDIA,
Tesla,
and Meta, which is Facebook.
Yep.
Okay, so those are the Magnificent Seven as it stands currently. It might not always be the case.
Well, and it's funny. I mean, that's a relatively new creation anyway, because there for a while it was FANG.
Facebook, Apple, NVIDIA, Netflix.
It wasn't even NVIDIA. It was
Netflix.
No,
Netflix. Sorry.
And then the N
got changed.
Changed.
Now nobody's came up with an acronym with 3 A's in it.
Yeah.
Maybe
call it the Magnificent Seven.
We should probably try that. We'll start a new thing. But it'll change as soon as we come up with it. So the Magnificent Seven as it stands right now is subject to be changed based on how large market cap of these companies are. And, NVIDIA is super strong because of the AI movement. But, I mean, you can call it what it is. I'll make a call. I don't think NVIDIA is always going to be there.
Well, and if you look at it, it's only there because of the market cap and its growth over the last 3 years.
But their profitability is terrible.
Even just their cash flow.
Yeah.
Like they're
not that big.
They don't make that much money, especially compared to the other 6.
Yes. Amazon does 5 times their revenue. Yeah. But regardless, NVIDIA is like a 10th the size or smaller than Amazon. And yet market cap, they're like neck and neck. Actually, right. NVIDIA might even be higher than Amazon.
They're $3 trillion on market cap.
Something stupid. On a tiny little company relative to how big these other ones are.
Well, it's just that future. They keep seeing the future. Investors do. So.
Yes. Okay. So let's talk about volatility and let's look at these. And again, and I want to keep saying this.
Buckle in. Please keep all arms, legs, whatever they say before a roller coaster, because that's what you're about to ride.
So we're not, again, I'm going to say this throughout the show. This is not a show against the Magnificent Seven. No. This is a show to help understand the dangers of relying on the Magnificent Seven for a dividend yield. The Magnificent Seven is awesome at growth, as we'll go over the numbers, but they're terrible at a dividend payout. I mean, you only have 4 of the companies, which, by the way, one of them just declared last year.
Yeah, one of them's barely.
Yeah. So 2 of the companies have been paying for greater than 10 years.
Mm-hmm.
One of them's been paying for a long time, but it's not even a yield, like 0.03%. I mean, yes, technically it is a dividend, but it's cents, literally pennies.
Well, in that yield, I mean, it's really gotten skewed in the past 3 years because of the extreme growth, right? So that's where you've got to be careful with some of these.
Yeah. So let's look at the actual volatility. We're only looking in a 10-year window. I could have went back further. But I just went in the last 10 years because most people that are going to watch this, they're only going to be like, just talk to me about the last 10 years. So that's what I did. And what I did is I looked at every single stock and I'm like, what's the worst return it's gotten in 1 year? Not in its company history, just in the last 10. And ironically, every single one of those companies had its worst year the same year, which was 2018. So in 2018, every single one of the Magnificent Seven had its worst. And ironically, every single one of these companies had its best year in the following year, 2019.
Imagine when you have such extreme trough there,
it's weird that it's the same year.
Yes.
And that's not normal. If we went back to its company origins, this would not be the case.
Right.
Their best years and their worst years would be all different. There might be some similarities, but since I used the last 10, it just happened to be the same year because 2018 was really, really bad in the market because of the Magnificent Seven, and the best just happened to be the very next year. So the volatility, if you look at these down the bat, and this is going to be interesting. So Apple pays a yield. Their yield is 0.5%. Okay. Their worst year in the last 10, they lost 57% to get back to break even the very next year. So if you lose 57% of your total worth in a single year, you have to double that the very next year. So they would have had to earn 114% growth the following year just to get back to where they were. Okay. Now, the good news is the very next year, this is what everybody looks at. They made 86%.
Yeah.
Yeah. They didn't even break even.
Yeah. Wonderful if you bought at the beginning of 2019.
And you didn't own.
Terrible if you bought at the beginning of 2018.
But, we're talking about a dividend portfolio. So owning the Magnificent Seven, you come hell or high water, as they say, you're holding it because you're like, these are the biggest, they earn the most, supposedly.
Yeah.
And I'm just gonna hold on because I have the same logic as a dividend investor. And dividend investor is the only reason why I'm buying is because they can't afford to pay. Well, none of these companies should ever be in that position because they have so much cash.
That's right.
Their balance sheets look so good for the most part. So you look at this, it lost 57%, didn't even get break even. And that was 2019. It has since surpassed that. But there's been many other volatilities of the stock.
Just not as extreme, which also, like, we've got to note, like, whenever the bad is so bad, it really helps that good year kind of rebound as well.
Correct.
Yep.
Next was Microsoft. Microsoft pays almost 1%, 0.8% dividend yield. And its worst year was only 28%. Now,
considering
Microsoft is the best dividend stock of the Magnificent Seven, and it's been paying the longest with a strong track record. I think it's no mistake that stock, didn't have a massive volatility. Now it's still almost 30%.
Sure.
However, it's only 28% when another one lost 57, another one lost 57, another one lost 64. This is like right in the competition for basically second place of the least loss. And then the very next year, it earned 57%, which is almost all of its gain back. Okay. Which is basically it broke even in those 2 years because every single one of these companies lost their worst in the last 10 in 1 year, and the very next year had their best year. And Microsoft was flat and paid the highest yield. The next is Google. Alphabet pays no dividend, lost 25% in 2018, and then gained 50%,
which is a net zero.
Net zero.
Just a lot of stress.
A lot of stress. Went down, came right back up. Netted nothing.
Yep. Then you have Amazon, who does not pay a dividend, just like Google, no dividend. They dropped also 25% and then rebounded 76%. So they actually came out
25%, 26% up.
Correct. Yeah. So that's great for them. And then Nvidia, but this is not the Nvidia we know now. Whenever you're looking back to 2018, they lost 57%, and then whenever they came back and rebounded in 2019,
2019 was almost the beginning of when that AI was hitting.
Right. So probably starting to have some conversations, which is helping them with that nice rebound of
that's when that beginning of that growth started.
But it's crazy. Like you said this about Apple, like whenever they were down in 2018. So Nvidia loses 57%, and then they come back the next year and it's 122. They barely
broke even. They made 122% and barely went above where they were.
Which is just
that's
wild.
Massive volatility. Yeah. Then you have Tesla. Tesla being kind of the outlier here. They only lost 11%. They have barely any losses in their company history. That stock just continues to climb.
I would love to look into that one a little more and figure out exactly, because I don't know that Tesla was shipping a whole bunch of cars in 2018.
Well, they became very profitable.
Okay.
So they started turning the corner. There's a lot of factors of why, but they have so many different offshoots of what they were doing. And there's, they had space, so many different things that came out of Tesla but I believe this was the year that their profitability turned.
So they were like, okay, we're starting
This
to
is
believe
a,
in
this
them.
is a model that is here to stay, and they lost 11%, which was their worst in the last 10 in 2018, and they earned 750%.
That's why I was like, I wonder what was going on around that time. I just don't remember because you have that 2019 where it's 700.
That's their best year ever, and that company hasn't been around forever.
Right.
And then you have Meta, who just declared here in the last year a yield or a dividend, and their current yield is about 33 or 0.33%. So it's a third of a percent. Their worst, and actually they were the worst in 2018. They lost 64%. And then which means they need 128% to break even the very next year, and they only earned back 56%. And the craziest thing, if you look across the board of all 7 of these, Meta has the highest profitability rate. Not the most cash, but they make the most cash percentage to their revenue every single year. And yet this is the most volatility of all of the stocks with the highest profitability of all of the stocks.
Wow.
You know why? Because they're terrible at spending their money. Tesla and Amazon are two stocks, in my opinion, in the same bucket. They're really good at spending money, and they're really good at investing it, not just spending it, putting it in place that turns more profit. You look at Amazon, it's like they have the Midas touch. Just about everything they touch turns profitable. They're willing to waste money on bad ideas because they know it's going to turn. Now, they're wasting money is little bits.
That's right.
You know, like 100 million, where in that for them, that's a little bit. Meta, they'll spend billions and not make any money.
Right.
And not even see a clear path to how it's going to make money. And that's why they're so volatile, because everybody's like, you have all this cash and you continue to waste.
Yeah, you continue to kind of have that mindset of.
And the only reason why they haven't gone bankrupt is because they have so much cash continually coming in, because their infrastructure is small. They're not expanding like Amazon. Amazon is like a behemoth of infrastructure.
Well, I mean, Meta, I just listened to a podcast. They have 3 billion people who use one of their platforms every day.
Every day. That's why they have so much cash.
2.3 billion use just Facebook each day. How do you grow?
Well,
you've got
they don't need to grow.
Correct, but I think that's why they implement the dividend. And,
they need to be like Amazon, where they find other ways to monetize their services, and they've been terrible. And they're not that I don't like Meta. I love the technology of virtual. But they have not found a way to monetize any of it. Now, I think they're the leader.
Right.
But they're not really, they're leading a charge to nowhere at this point.
Yep.
And that's why there's such massive volatility, where they went horribly backwards. They didn't even earn 50% of what they lost in 2018.
Right.
So the reason why we're bringing this up, again, is not to say this is a bad portfolio. This is a very good portfolio. It's just not a dividend portfolio.
Right. Yeah. This is not something you would want to invest in if your goal is to really draw out income, live on that. This is the type that if you have a really good stomach and you can weather the worst, you know, it can have some good years as well.
Yeah. And I've actually, every single one of these stocks that pay a dividend outside of NVIDIA, we've added into our Div 50 account. You know, even Facebook, which I don't even like, you know, but I feel like they're itching ever so closely to the reality that they're going to hit on it at some point.
Yep.
So I do like the Magnificent Seven. I think from a growth portfolio, you really can't get better as long as you can stomach the massive roller coaster of volatility. Now, I want to contrast that to an actual dividend portfolio, our Div 30. We went 10 years here, and we're looking at the worst volatility in a given year. And if you look at this, 25% was the number. Like, that was the least amount that one of them. So it was 25% to 64%. So you have a huge gap of loss. So 25% was the best loss in that given year. And if you go back in their company history, those numbers are way worse than just the last 10.
Oh, yeah, for sure.
Okay, because you had the bubble burst. You had a lot of bad things in there for some of these companies that were around. Contrast that to the last 25 years of our portfolio. We want to look at 25 years of our portfolio in dividend investing, going back. And I can tell you, looking at our numbers, there was only, how many years was it? 1, 2, 3, for 5 years of the last 25 years, our portfolio went negative. The worst being in 2008, our portfolio lost about 24%.
Which we didn't even pull up for them.
Yeah, we didn't even pull up 08. And our portfolio lost 24%. That's the dividend portfolio. Theirs were way worse than these numbers because the Magnificent Seven in 2018 lost almost 39% that year. And that's averaging them all across the board. You know, actually, I misspoke. I said 25%. It was negative 11 for Tesla.
Yeah, they're kind of that outlier.
Yeah, that was that.
We'll let it be an outlier.
And they were just getting started as a company. So 39%, 38% was their worst in 2018, going back 25 years with a pool of more than just the biggest 7. You know, we've got 30 companies. There was 24%. And all we're doing, we're not competing our portfolio versus theirs. We're just looking at a pool of dividend stocks in the worst volatility. Our worst year was 24%. Our second worst year was 12%. So we had one funky, the world burned down, bonds went belly up. Like in 2008, that was a very, very bad year. We lost 24%. The second worst was 12%.
You know, just so we're looking at similar years. If you go to 18, so 2018, which is what we've identified as all of the Magnificent Seven's worst year, the portfolio that we managed at that time was 8.78. So down 8.78.
So
you're
better
down
than
8%.
their best, which was Tesla at 11.
And then the rebound, it was 22.6. So not as high as theirs.
However,
we're not even in the hole. So when you net that out, there were only a couple of companies that even got positive, which we're far surpassing what we would need to get back out of that hole.
So if we were down 8 and then we went 20-some%, we almost tripled our value in the same 2-year period. Tripled the return against what we saw there. I mean, the best one was Amazon, who netted 26% over that same 2-year period. And that was the best. We were pretty close with that. I mean, we were in the teens, 15, but that was on our entire portfolio.
Right.
If you net the two together, we're way farther ahead.
Right.
And this is a boring dividend for old people, as the investors say. Like, the only people that want to buy a dividend portfolio are the investors who are either in retirement or, you know, they're adverse to risk, whatever. We're taking a portfolio that would be classified as conservative boring against the Magnificent Seven. And in the same worst to best, we netted a better return than the Magnificent Seven in a dividend portfolio. And then you're going to say, well, you extrapolate that out. If we go back 25 years, our return beats the Magnificent Seven.
Yeah.
So and it's not because we have better stocks. It's because our bad years are way better than their bad years. And our good years are more consistently good years year in and year out.
Yeah, those are really big holes to have to dig out of when you lose, you know, 50%. Like when you lose 50%, it's not 50% return the next year to get out. It's 100%. So when you have to have that consistently to get out of those really, really bad years, it can weigh down the overall stock for sure.
And one other thing I'm going to point out before we shut down.
Yeah.
We've got Apple tech, Microsoft tech, Google tech, Amazon. I'm not sure what we're going to really call that, but it's kind of tech, infrastructure, NVIDIA tech, Tesla tech, and Facebook, Meta, which is tech social. You have 7 companies that basically do, out with the exception of Tesla and Amazon, you have the same companies doing the same thing, competing almost with each other to some degrees in varying arms of their industries. It's a portfolio of kind of the same thing. Okay.
Why they, you know, they're pushing it forward.
Yeah.
But they're
Which
also
is awesome.
Yeah.
And the reason why our portfolio has done what it's done, and not necessarily just a dividend batch of good, strong stocks, could have probably outperformed Magnificent Seven over time. When you do that contrast, this is where diversification really becomes important.
That's right.
Because these stocks do very, very well, but they're just batched together. They're kind of the same thing, which tells you, I mean, you have one leading industry, which is tech, and then you have everything else. Okay. The everything else does very well. Okay.
Correct,
It's just not as exciting.
Right.
You know,
Yeah.
when you look at the Magnificent
Yeah.
Seven, like it puts a smile on my face too. Like,
Yeah.
this is awesome. Like watching them go 100% in a given year or 700%. Like, who doesn't want to be a part of that?
And which is awesome. You know, the drop on the Fury is sometimes, you know, it's kind of the opposite of a real roller coaster. You love the drops, but those hills and stuff slowing it down. Man, I just don't know that I personally have the stomach. Like seeing -6 versus -68, that feels a lot better over there than even the good of like, I made 22, but I could have made 76 or 122.
But the net yield over time
Correct.
is consistently better. So hopefully you've learned something out of this show. And again, just to say it one more time, I'm not saying the Magnificent Seven is a bad portfolio. You know, for an investor who has planned for their income, understands their needs, and has some surplus, you know, throwing a little bit of money into this batch is not a bad thing. I'm actually all for it in the right situation.
Correct.
You mix in some other stocks that are the same to add some more diversification. I think you've got an awesome thing. But we're just looking at it through the lens is the Magnificent Seven a dividend portfolio?
Yeah.
And it's a resounding no.
Yeah, it's not one I would want to be invested in.
Not just
like if you invest in it, don't call it I'm invested in a dividend portfolio.
If you have any questions, obviously you can always reach out. It's been a fun discussion today.